right, welcome to Iron Financial. This is the channel where we help you forge a stronger portfolio, cutting right through all the market weakness. And today we've got a really interesting one. We are putting Groupon under the microscope. This is a stock that just got absolutely hammered after its Q4 earnings. I mean, the market is basically treating it like a demolition site. So the big question we've got to answer is the market right? Or is this actually a ground floor opportunity to get in on a company that's finally starting to rebuild its foundation? Let's get into it.
So, let's just start with the market's raw verdict. And it was delivered with all the subtlety of a wrecking ball, negative 14%. Right after their earnings announcement, investors just stampeded for the exits, sending the stock into a free fall. Look, this wasn't just a slight dip, all right? This was a massive vote of no confidence. It was a crystal clear signal that Wall Street looked at the numbers, hated what they saw, and wanted out immediately. This is the kind of brutal gut punch reaction that tells you something is either deeply, deeply wrong, or maybe, just maybe, deeply misunderstood. And our job today is to figure out which one it is.
So why did the market react so violently? Well, because the company whiffed. They missed expectations pretty much across the board. Just take a look here. Their earnings per share, it came in at 17 cents. Now, the analysts were expecting 25 cents. That's a full 8-cent miss. That's significant. Then you look at the top line, the revenue. They brought in just under $133 million bucks. The street was looking for over $7 million more than that. You have to understand, in a market this jittery, you simply cannot miss on both the top and the bottom lines and expect to walk away without a scratch. This was a fundamental failure to deliver on their promises, and the stock paid a heavy price for it.
So let's start with Section 1, the market bloodbath.
Okay, hold on a second. So that's the damage report, right? An absolute disaster on the numbers, a total bloodbath. But then you get this quote from the CEO, Dusan Senkyul, and he's out here calling it a landmark achievement. He's talking about a return to growth for the first time in a decade. I mean, how on earth do you square that with a 14% stock plunge? Are we looking at the same company? Is this guy living in a completely different reality or something? Because this massive disconnect, that's the mystery we have to solve here. It just doesn't add up.
Exactly. And before we even try to make sense of what the CEO is saying, we have to do our own due diligence. We have to be the architects of our own portfolios. And that means we absolutely must inspect the foundation of any potential investment before we put our capital to work. We have to conduct a full forensic analysis of Groupon's financial structure to see if this building is even sound to begin with. So let's forget the press release for a minute, forget the happy talk and the narrative, and let's look at the cold, hard numbers, the structural integrity of this company.
And we're going to start with one of the single most important metrics for assessing financial distress. It's called the Altman Z-Score. Now, this isn't some obscure number. It's a critical stress test. It's specifically designed to predict the likelihood of a company going bankrupt. For Groupon, that score is a deeply troubling negative 2.94. This isn't just a poor score, folks. This is a dire warning, a siren going off.
Yeah, and I really want to hammer this point home for everyone watching. Let's be crystal clear about what that number actually means. The lead analyst isn't just pointing out a bad metric. As you can see, the official distress zone starts at a score of 1.8. Groupon is, well, it's miles and miles past that. A score of negative 2.94 isn't just a little red flag waving in the breeze. No, this is a full-blown 5-alarm fire. The model is basically screaming at the top of its lungs that this company is a serious bankruptcy risk.
Right, now let's move on to the next major crack we found in this foundation, return on equity. This number is so important, it tells you exactly how efficiently a company is using money from its shareholders to generate profits. And for Groupon, it is a staggering negative 717%. I mean, that is an almost unbelievable figure. Let that sink in. It means the company isn't just failing to generate a return on shareholder capital. It is actively, aggressively destroying shareholder value at an astronomical rate. This goes beyond just bad management. This is a catastrophic problem with capital allocation.
And you have to understand, this decay, this isn't a new problem. This has been a long, slow rot. If we look at the 3-year revenue growth rate, what do we see? We see an annualized decline of over 24%. This isn't a one-quarter blip caused by a bad economy or something. No, this is a multi-year trend of the entire business shrinking. Its customers leaving, its merchants walking away, and its revenue just evaporating into thin air. It reinforces the whole bear case that the core business model has been fundamentally broken for a very long time. And it just keeps getting worse. The hits just keep on coming. Look at this laundry list of problems. A net margin of negative 28%, an EBITDA margin of negative 12%. They are just burning cash at every single level of the business. And on top of all that, a debt-to-equity ratio over 4. That means they are absolutely buried in debt. And maybe the most urgent, most immediate problem is the current ratio sitting at 0.93. That suggests they might not even have enough cash on hand to pay their bills in the short term. So I have to ask the question again. Lead Analyst, looking at all these massive structural failures, how in the world can the CEO get on a conference call and claim victory? How is this company not already insolvent?
I know. Looking at this, it seems like an open and shut case, right? It looks like a complete financial demolition site. Honestly, any rational investor just looking at these numbers would be running for the hills. And, that's exactly why we do what we do here at Iron Financial. Because the easy story, it's rarely the whole story. If you stop right here, you're going to miss the critical evidence, the stuff that actually explains the CEO's comments. So stick with us, because this is where the whole plot thickens.
All right, so now we're going to put that landmark achievement quote from the CEO directly under the microscope. Was it all just empty corporate spin? Was it just smoke and mirrors? Or is there actually some solid steel rebar hidden somewhere underneath all of this financial rubble? We need to start looking for the first tangible signs of life. Those green shoots that might suggest a real sustainable turnaround could actually be underway.
And here it is. This, right here, is the single most important data point for anyone trying to build a bull case for Groupon. For the full year 2024, revenue was $492.6 million. In 2025, it ticked up just a bit to $498.4 million. Now look, that is not a massive jump. I get it. But it's not the size of the growth that matters here. It's the direction. Because as this chart clearly shows, this is the first time in 10 years, an entire decade, that Groupon has managed to post year-over-year revenue growth. A 10-year losing streak of decline has finally been broken.
And you know what? That little bit of revenue growth, it fueled something much more significant in the fourth quarter. For the first time in what feels like an eternity, they were actually profitable. They posted a positive net income of $8.1 million. But even more importantly, look at this. They generated $53 million in positive free cash flow. You can play all sorts of games with accounting, but you can't fake cash in the bank. And to top it all off, active customers grew by 5% year over year to 16.2 million. So they're not just squeezing more money from fewer people, they are actually bringing people back to the platform. That's huge.
Okay, so I see it. There's a pulse. We can see the profit, we can see the cash flow. That's real. But is this a genuine recovery, or is it just a classic dead cat bounce? We really need to know where this strength is coming from, because as we just spent the last few minutes establishing, the overall foundation is an absolute wreck. Is this growth coming from their core business in North America, or is it some kind of financial engineering, some one-time event? Seriously, is one good quarter really enough to bet the farm on?
And that right there is the billion-dollar question. When you have a story this conflicted, a truly terrible long-term foundation, but with the very first signs of a turnaround, you need more data, you need more signals. And one of the best ways to get a read on a complex situation like this is to follow the money. We need to see what the big institutional investors, the so-called smart money, are doing. Are the biggest, best-funded hedge funds on the planet buying into this bull case, or are they siding with the bears and running away? And what we find is a complete battlefield. The smart money is totally divided. I mean, look at this. On one side, you have an absolute giant like Millennium Management adding almost 700,000 shares. That's a massive 749% increase to their position. Then you have Exodus Point Capital coming in and establishing a brand new position worth nearly $6 million. These guys are making a significant bet on the turnaround. But on the other side of that exact same trade, you have T. Capital Management dumping their entire position. We're talking over 1 million shares worth $19 million. Gone. And Renaissance Technologies, one of the most respected quant funds on Earth, they sold off over 80% of their holdings. This is not a slight disagreement. This is a high-stakes war between financial titans.
This is exactly what makes it so incredibly difficult for the average retail investor. It's maddening. You have these multi-billion-dollar funds with entire armies of analysts with proprietary algorithms we couldn't even dream of, and they are all looking at the exact same set of facts. Yet they are coming to completely opposite multi-million-dollar conclusions. One firm is buying hand over fist, the other is selling just as fast. It just goes to show you how much uncertainty and how much raw risk is baked into this stock right now. If the pros can't agree, it really just underscores how speculative this situation truly is for the rest of us.
And these conflicting signals, they don't stop with the hedge funds. Not at all. Just look at the official Wall Street analyst consensus. Hold.
That is basically the entire analyst community shrugging its shoulders saying, we have no idea. You've got buy ratings, hold ratings, and sell ratings all at the same time. You've got an average price target that suggests huge potential upside, but that is completely undermined by the company's own guidance. They are literally telling you that 2026 is going to be subdued and that the next quarter will see flat growth. They are basically telling the market, hey, don't get your hopes up. It's an incredibly mixed message.
Okay, it's time. Time to put all the pieces together. We've done the forensic analysis, we've inspected the foundation, and we've found deep, significant structural cracks. But we have also seen the first signs of new construction. The first real evidence that a rebuild might actually be possible. So now, it's time to lay out the final blueprint and deliver a clear verdict for the Iron Financial portfolio.
So it really boils down to this. On one hand, you have the bear case. This company looks like a total demolition site. The Altman Z-Score is a code red bankruptcy warning. The return on equity is a complete nightmare, showing a long history of just incinerating shareholder value. They've been shrinking for years and have very real liquidity concerns. And to top it off, their own guidance for the future is terrible. But on the other hand, you absolutely cannot ignore the bull case. You can't just dismiss the first revenue growth in a decade. That's a huge milestone. A profitable fourth quarter that generated $53 million in positive free cash flow is a massive signal. Customers are starting to come back, and a financial titan like Millennium is pouring millions and millions of dollars into the stock, betting that this, right now, is the bottom.
So here is the final verdict from Iron Financial. Groupon is absolutely not a stock for the faint of heart. This is not a stable pillar that you can use to build a long-term durable portfolio. The structural risks are severe and they are real. However, for an investor with a very high tolerance for risk and maybe a 3 to 5 year time horizon, it does represent a potential high leverage bet. To own this stock, you have to truly believe 3 things. 1, that the growth we saw in Q4 is the start of a durable new trend and not just a fluke. 2, that management can continue to manage their cash flow effectively to avoid a liquidity crisis. And 3, that they can do all of this before their massive debt load completely crushes them. This is not a cornerstone investment. It is a calculated, speculative bet on a very, very difficult turnaround. You're betting on the blueprint, not the finished building.
So in the end, we leave you with the final question that you have to answer for your own portfolio. After a full decade of decay and value destruction, are these recent green shoots really the beginning of a new, solid foundation being built from the ground up? Or is this just a fresh coat of paint that's been slapped on a condemned property right before it finally collapses? The smartest minds on Wall Street are completely divided. The numbers themselves tell 2 completely different stories. And now, it's up to you to weigh all the evidence and decide which story you believe.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before